The double bottom chart pattern presented by finvids.com Finance Videos. In this video, we will discuss the terminology and statistics of the double bottom pattern. We will discuss all four of the various double bottom patterns: Adam and Adam, Eve and Eve, Adam and Eve, and Eve and Adam. We will show the expected average gains of each of those four double bottom patterns, as well as a discussion of the psychology of the double bottom pattern and why it works. We'll give two real-life chart examples of the double bottom pattern. Now, what is not included in this video, but is included in the content below this video at finvids.com, is the price target for the double bottom pattern. Once traders buy the breakout, they need to know when to sell out to maximize profit. The double bottom begins with a downtrend. Prices then retrace upwards. This creates what's referred to as the left bottom. Now, after the retracement uptrend, prices then begin moving downwards. This creates what's referred to as the middle peak. The middle peak also establishes the future overhead resistance line of this pattern. Now, once prices after the downtrend begin moving upwards, this creates what's referred to as the right bottom. Now, as prices reach the overhead resistance line, if they break out above that resistance line, then a buy signal is triggered. As is the case, prices often do what is referred to as pullback back to the resistance line. Now, as is typical in chart patterns, a past resistance that is broken becomes a new support, and prices typically move higher. For a valid double bottom pattern, the difference between the lowest bottom and the middle peak should be at least 10%, and the left and right bottoms should be within 2 to 5% of one another. Typically, the left and right bottoms should be separated by a period of 2 to 6 weeks. Now, a double bottom begins by making a lower low, which is a continuation of the downtrend. Prices then rise and then fall again, creating a lower high. So thus far we have just a continuation of a downtrend. A downtrend by definition is a lower lows and lower highs. Now here we have a low that should be lower than the prior low in order to persist the downtrend. However, the price is at the same price level as the previous low. This suggests that the downtrend is in trouble. Now, when prices reach the prior lower high and then break out above it, then the very definition of a downtrend, lower lows and lower highs, has been broken. Typically, after the pullback, this creates a higher high. So now we have a higher high, which is part of the definition of an uptrend. And after prices bounce off the old resistance and move higher, they create a higher low, which is the other portion of the definition of an uptrend. There are four anatomically suggestive double bottom patterns. We begin with the female Eve and Eve double bottom. Now, each of the bottoms is rounded and occurs typically over multiple days. The average max gain before any 20% retracement after the breakout above the resistance line is 40%. Note that according to Bulkowski, this is the most successful double bottom pattern. In contrast, we have the Mel version, the atom and atom double bottom. Now these show two sharp spiked bottoms, typically a single day. The atom and atom is the least successful, but nevertheless successful, of the double bottom patterns. The average maximum gain before any retracement of 20% or more is 35%. Next, we have the Adam and Eve double bottom. The first bottom is a sharp spiked, typically single day bottom, whereas the second bottom is a rounded multi-day bottom. Now the Adam and Eve double bottom is the second best performing double bottom pattern when prices break out above the overhead resistance line. The maximum average gain is about 37%. And lastly, we have the Eve and Adam double bottom. The first bottom is a rounded multi-day bottom, whereas the second bottom is a sharp spiked, typically single day bottom. Now the Eve and Adam double bottom is the third best performing double bottom. The average max gain after the breakout is 37%. Here we have an Eve and Eve double bottom. We begin with a downtrend. We have prices making a multi-day low. Prices retrace upward. Notice that the high is still lower than the prior highs, so the downtrend is still intact. Prices then fall. However, the low is not a new low. So this is a preliminary suggestion that the downtrend could be ending. And we draw a resistance line at the middle peak. Now prices here broke out above the resistance line. This signals the end of the downtrend and suggests a future new uptrend, which in this chart example is the case. This chart of the S&P 500 illustrates an atom and atom double bottom. So we begin with a downtrend, lower lows, lower highs. Here we have a 2-day spike bottom, followed by a retracement higher. Now notice that the high is lower than the prior high, so we have lower highs. So the downtrend is still intact. And we have another spike bottom. Prices rise back to the level of the middle peak. Once they reach that overhead resistance line, if they break out, then it's clear that the downtrend has ended and a future uptrend is suggested. Here we have a very typical pullback, and prices head higher, making higher highs and higher lows. Please go to finvids.com to see the 37 other chart pattern videos, as well as the 33 candlestick chart patterns.